Hello and welcome back to Wall Street Training's Accounting and Financial Statement Integration, Hands-on Exercise and Project. By now, hopefully you would have already completed the answers and gone through the financial statements, extracted the numbers, input it into page 1, calculated the ratios for page 2 and 3, and gone through your own assessment as to which company you would recommend based on the ratios that you arrived at. Remember, folks, don't cheat. Please make sure you have done the answers first, otherwise you're only cheating yourself. With that in mind, let's go ahead now and flip first to our first page of inputs. Let's take a look at Walmart. A common error here is for the last year that we want, the latest year, revenues. Many people sometimes accidentally take the sales number. We actually want to include, as we've said many times in our instructions, we want to include total net revenue. Therefore, the actual number you want is 315,654. So let's go ahead and input that number into our financials. So here, let's just quickly set this up so you can easily see this. Freeze frame it, zoom it in. So now, first for Walmart, not in cell, but in your grid, you should have hopefully entered 315,654. Now, folks, you saw that. I will occasionally throw an error up here intentionally on the screen. Your job is to catch me and tell me that I screwed up. So then I will go back and I will fix it. And if I do make an error, I can just say I was just testing you. All right. Now, let's go back to our numbers. What we want to do next here is we want to take a look at this and we say, what is our COGS, our cost of sales? Simply 240,391. So let's go ahead and input 240,391. Of course, you will write that down in your answer grid. In this particular case here, we were not provided with a gross profit number for Walmart. They just went straight from COGS, straight down to SG&A. They did not provide us with a gross profit. So here, we will simply have to recalculate our number. So we'll just say equals, in this case, I'll say the 315 minus the 240,391. Now here, I will get actually precise numbers. So when I get precise numbers here, you may be off slightly by rounding. That's okay. Get the point. So now your gross profit of 75,263. The next number I need is my EBIT number. So let me go back and get my EBIT number from Walmart. EBIT is the same thing as operating income. That number, 18,530. So please, you will have written down 18,530 in your answers. EBITDA, let's skip that for a quick second. We got to get DNA from our number down below. But let's get our interest expense number. Our interest expense, the total interest expense net is 1172. However, we specifically asked you to make sure you get the gross number. Gross means do not include this interest income, which reduces your total interest expense. You effectively, therefore, want to take the sum of this 1171 and this 249. So we'll go back to our Excel, and here I will say equals 1171 plus 249 gets us a total of 1420. Now, of course, I know I'm cheating a little bit because I've got Excel, but that's okay. You should have done this on a calculator to do it the correct way to make sure you understand the true source of these numbers. Now, net income from continuing operations. You will make sure that you grab that from the continuing net income from continuing ops, which is going to be which number? That number will be right here, net income of 11,231. There are no discontinued operations. If you were looking at this year, you would have used this number and not this number because, again, what do we always want? Core, recurring, sustainable profitability. And clearly, discontinued will no longer be going forward in the future. 11,231 is the number you want to input in here. Let us now flip down to the balance sheet. Balance sheet for Walmart on the cash. Let us take a look at this. What is our cash and cash equivalents? 6414. Please go ahead and input that number, 6414, into your numbers. Accounts receivable balance will be receivables, 2662. Let's take a look and cheat ahead. Inventories will be 191. So 2662, 191. Our total current assets will simply be this number right here, nice and easy. They gave it to you already, 43,824. And again, let's skip ahead. What's our total assets? 138,187. So let's go ahead and input those two numbers in the correct spot. So on the current assets, what was the number again? 43,824. Total assets, 138,187. Now we're going to flip ahead to the liabilities section. The liabilities will say the following. Let's flip down here. Liabilities, the first number we wanted was accounts payable. Accounts payable is 25,373. Let's now also input the next number, current liabilities. 48,826. So let's go ahead and input those two numbers. And why don't we go ahead and quickly grab total shareholders' equity as well. We'll come back to debt in a second. That requires slightly longer of an explanation. So total shareholders' equity, 53,171. Let's go ahead and grab those numbers. Again, accounts payable was $25,373. So accounts payable $25,373. Current liabilities is $48,826. Total debt, we're going to leave blank for a second. Equity, if you recall, was $53,171. Let's now look at our total debt numbers. Per our notes and instructions, we specifically asked you to please include commercial paper. So you want to include that number. Commercial paper is simply paper that's commercial. Well, okay, I know that's not very value added either. What's commercial paper? Commercial paper simply is very short-term financing, typically used to fund working capital. It is also short-term. How short? Typically anywhere between 30, 60, or 90 days, but by legally it's going to be less than 270 days because anything greater than 270 days requires SEC registration, so we try to avoid that by keeping it less than 270 days. Finally, commercial paper, other interesting attribute about it is sold at a discount because it is so short-term. There is no point in paying your cash coupon. Therefore, since it's sold at a discount, it is a zero coupon bond, which means that all the gains are going to go through capital gains as opposed to current income of interest. So that's the first thing we'll include for commercial paper. Now, the next question we're going to ask ourselves is, well, first of all, that's the 3754 number. Do we want to include accounts payable? Well, folks, did we say, what was accounts payable? Is that considered debt? Nope, that is not. Put an X mark next to it. Accrued liabilities. Remember, think about my definition of debt again. Interest-bearing negotiated securities. Is accrued liabilities an interest-bearing negotiated security? It is not. From the accountant's definition, once again, debt includes total liabilities. From a financial analyst perspective, which is the perspective that we will take as financial analysts, we want to make sure that we just grab capital structure, financing-related decisions as opposed to operating-related activities. So therefore, we will exclude that accounts payable and the accrued liabilities number. Going ahead, so we exclude both of those. Accrued income taxes, same thing. We're going to kill that as well. They will not include that as a form of debt. Long-term debt due within 1 year. Well, folks, that tells me that's pretty straightforward. It tells me right away, yes, I want to include that. That is the 4595 number. Obligations under capital leases due within 1 year. As specifically mentioned, we are going to exclude this number. Please do not include it as a form of debt. For a fuller explanation of that, please go to our corporate valuation module. Total current liabilities, we will not include that as a subtotal. Long-term debt, we definitely want to include. If you don't include that, I don't know what other number you would want to include. So that's the 26429 number. Finally, long-term obligations under capital leases. Similarly, we're going to exclude capital leases in this particular exercise. Deferred income taxes doesn't apply in terms of debt. And we also specifically ask you to please include minority interest. And that number, again, will be that 4552. And we will go ahead and have a fuller explanation in our corporate valuation module. Commitments and contingencies, that is basically debt or nope, that is neither. That is incorrect. Folks, you should have caught me on that one. Actually, minority interest is actually going to be that 1467. I was just testing you on that one. Commitments and contingencies, nothing going on there. And everything else after that is equity. So folks, think about this. Once again, you want to make sure in your total debt numbers you have included short-term, long-term, commercial paper, anything that is interest-bearing negotiated security. Minority interest is neither interest-bearing nor negotiated. However, we're going to include that because it's considered a form of capital. Again, we will describe more of that on the corporate valuation module, so please feel free to flip to that after you're done with this as well. Now, let's take the sum of these four numbers into our total debt numbers, and let's take a look at our end result. 3754 was commercial paper, plus 4595, plus 26429, plus 1467. The total debt that I want you to make sure you have included is 36,245. Now, let's go ahead and flip to our cash flow statement. Our cash flow statement says the following. Our cash flow statement, D&A, depreciation and amortization, is going to be 4717. Payments for property and equipment, this is our CapEx. We actually won't use this number right now, but 14,563, just make sure you can locate it. So let's, again, go to D&A and type that number in, or rather input that number in, 4717. CapEx will be that 14,563. Now, let's go ahead and complete our EBITDA. Our EBITDA will be the sum of our EBIT, 18,503, plus that D&A number down there, 4717. Again, that EBITDA number will be that 23,247, which is comprised of EBIT, operating income, plus our depreciation and amortization number of 4717. We have now included and finished the inputs for our Walmart. Let's go ahead and do the next company, Target on our list. Let's go through that very quickly, do the same thing, and then also do the same thing for Costco, and then let's quickly calculate all of our ratios. So going back here, we will now look at target. Our target total revenue is going to be 52,620. 52,620 is our number. Our COGS is going to be 34,927. Depreciation and amortization, actually, they've already given it to us at 1409, but we want to get this from the cash flow statement, so we want to check that the number is the same. The vast majority of circumstances, it is the same. For our gross profit, which is not given to us, we have to take the difference of these two numbers, and let's take a look and see if they give us our EBIT, our operating income. Earnings from continuing operations, that's the E. Before, that's the B. Interest expense and income taxes, that 4323 looks like a good number to me. To get our EBITDA numbers, as again, we will take the sum of these two numbers. And to get our interest expense is this 463 number. This 463, they did not give us a gross number. That's okay, because I did not provide you with the footnotes to give you the full breakdown. Net income will be earnings from continuing operations, which is our 2408. If we were in 2004 at the previous year, you would have still included and used that 1885. You would not have used these discontinued items. So let's go ahead and input these numbers and make sure we understand where they're coming from. So let's go ahead to target. Total revenue is 52,620. COGS is 34,927. Gross profit is the difference between those two numbers. These numbers hopefully you should have written down and calculated already on your answer grid. EBIT was 4323. EBITDA, let's quickly go down, and I'm going to just quickly put in 1409. I'll cheat real quick. That was my DNA number. So I will go ahead and I will calculate EBITDA as the sum of EBIT 4323 plus that number down here 1409. You should have an EBITDA number of 5732. Our interest expense, if you recall, was 463, and our net income from continuing ops was 2408. We have now finished our inputs for the income statement for Walmart as well as for Target. Let us now go to balance sheet for Target. The balance sheet, statement of financial position. Let's take a quick look at the numbers that we want. The first number we want is cash. Cash is 1648. Accounts receivable and inventory are 5666 and 5838. Total current assets is 1404. The other number that we were requesting was our total assets number 34995. So we will now want to input these 1, 2, 3, 4 numbers into our balance sheet assets section. So let's go ahead and let's do that. Cash and equivalents, again, was 1648. Accounts receivable was 65666. Inventory was 5838. Current assets 14405. Total assets 34995. Let's go ahead and start doing our liabilities. Let's do our accounts payable, current liabilities, as well as our equity, and then we'll come back and do a full explanation of our debt. So on our accounts payable, we quickly flip back to our balance sheet here. We'll look at this and say, oh, here's our accounts payable, 6268. We would then look at our current liabilities. Our current liabilities is right here, a little bit hidden, 9588. Our equity amount, total shareholders investment, is 14205. Let's put those three numbers in there real quick, and then we'll look at our debt calculation. Again, let's look at accounts payable, 6268. 6268, our current liabilities was 9588. Our equity amount was 14205. Let's look at our total equity, total debt numbers now. Our total debt numbers, accounts payable, we do not want to include that. No accrued and no income taxes as we talked about previously. Current portion of long-term debt and notes payable, that sounds like a debt item to me. Total current liabilities, no, that's a subtotal. Long-term debt, that sounds good to me as well. Deferred income taxes, nope. Other non-current liabilities, doesn't sound like it's going to fall under debt either. Shareholders investment, no dice. So now you would take the 753 number and add to that the 9119 number. So fairly straightforward on this one. A little bit easier than the Walmart. So on my total debt, I would say equals 753 plus 9119, and your answer should now be 9872. Let's quickly finish this up. Again, we already got our DNA number in there. So let's go ahead and grab our, well, let's check that number is good, and let's also look at our CapEx. So our DNA number is going to be right on top, 1409, and indeed that checks to the income statement. Life is good, no adjustments required. If there was a difference, always grab it from the cash flow statement because that is a better and truer indication of the cash amount. Cash flow from investing, we want our CapEx, expenditures for property and equipment, 3388. Let's go ahead and add in that last number, 3388, and we're all done inputting target. Let's now go ahead to Costco. Costco, our good old Costco, guys. Okay, revenue. First of all, keep in mind, as I mentioned, these numbers are in thousands. We wanted to round it to millions. Now, do keep in mind that when I crunch these numbers here, I'm going to round them as opposed to using full precision here. So you should have also inputted those numbers on a rounded basis. Total revenue for the last available year was 52,935. We'll just whack off the last three, keep it at 935. So 52,935 is the number we will want to input. Merchandise cost, that's actually our COGS. You can enter in 46,347, please. Whack off the last three over there. That will be 46,347. Please do round to the nearest millions. They do not give us an item for gross profit, so we will have to calculate revenue minus COGS shortly. EBIT, operating income, 1474, 303. Again, you can just round it and keep it as 1474. Interest expense, they gave you the gross amount. Do not net it out. We asked for gross interest. You put in 34 is sufficient. Net income, they did not have any discontinued here. Net income is simply 1063. So let's go ahead and let's input these numbers right now into your answer grid. Or rather, you should have done that already. Let me put them in. 52,935. COGS was 46,347. Then 6588. Actually, let's just subtract the 2. And we will get 6588 to make sure that you did calculate that. EBIT, operating income, was 1474 straight from the financials. EBITDA, let's hold off on that for a second. We don't have our DNA number yet. Interest expense will be that 34 under interest, and net income will be that 1063. So now let's go ahead and go back to our balance sheet for Costco. Balance sheet for cash. Here's going to be a little bit tricky. Balance sheet for cash. You want to make sure that you include cash and equivalents as well as short-term investments. Folks, if you did not do that, if you accidentally did not include short-term investments, if you didn't put in short-term investments, go ahead and take the time now, pause the video, go back and recrunch your numbers, add in short-term investments into your cash amount, then recalculate your net debt numbers, and I think that's really the only number you need to calculate, so not too much recalculation, but go ahead and take the time to do that now. Why do we want to include short-term investments? If that's a cash equivalent, then you also want to say that's part of cash. If it's a restricted cash item, you definitely do not want to include it. Now, how could you have known that short-term investments was part of cash and cash equivalents? First of all, you might have suspected as such because of the label. But you don't know 100% because I did not provide you with the footnotes, so I agree that wasn't necessarily fair. But in the footnotes, you will clearly see that Costco says short-term investments is highly liquid investments, treasury bonds, corporate bonds, etc., that are highly liquid, that can be converted into cash in a very quick 30, 60, or 90 days. So when you read that footnote, it's pretty clear that cash, that could be considered as a cash equivalent. So now, we'll look at this and we'll say, let's take our 2063, round it up, plus our 1397 number, and let's take a look at what that results in. While we're at it, let's take a look at receivables net. That's 399.9, so this make that 400 rounded. Inventories, that's 4015. 4015, please, because we are going to round to the nearest million. Take a look at current assets. 8086 is sufficient. And our total assets will be, where is our total assets? 16,513. You will round that to 16,514. So on the cash and equivalents, let's see if we can remember this. 2063 plus 1397. 2063 plus 1397 equals 2063 plus 1397 equals 3460. Accounts receivable was $400. Inventory was 4015. Current assets is 8086 and total assets is 16,514. Let's see if I remember those numbers correctly. Help me remember that. 3460, 400, 4015, 8086, and 16,514. And let's take a look. Did we get those numbers right? 16,514 was correct. 8086 was the rounded number there. 4015, 400, perfect. Good. Let's take a look at our current liabilities now. Our current liabilities will say the following. Short-term borrowings, let's exclude that for the time being. Let's take a look at accounts payable. 4214 on a rounded basis. Current liabilities, 6609 rounded. take a look at our equity amounts. We'll come back to that in a second. Our equity amount is going to be 8881, piece of cake. So let's go ahead and input those three numbers into our liabilities and equity section. Accounts payable was 4214. Current liabilities 6609. Total debt, let's skip that for a second. Equity was 8881. Let's take a look at our total debt calculation now. Our total debt calculation says the following. Do we want to include short-term borrowings? Well, folks, that sounds like a debt item to me. No accounts payable, no accrued salaries, no accrued sales, no deferred membership income. Current portion long-term debt, that's a money one, that's good. Current liabilities, nope. Other current, nope. Total, subtotal, no good. Long-term debt excluding current portion, sounds like a good number to me. Total liabilities, that's a subtotal. Commitment to continue, minority interest, buzzword right there. So let's go ahead and let's take the sum of these numbers. We can round it. We'll say 54 plus 3 plus 711 is okay, plus 59. Let's just keep it simple for now. Of course, in reality, you will want to go ahead and actually input the full significant digits. So our debt numbers will equal 54 plus 3 plus 711 plus 59 for a total debt of $827. Let's go ahead now and look at our DNA number. Our DNA number is going to be the following. DNA 478 rounded. Additions to property and equipment, 995 for CapEx, rounded as well. Let's go ahead now and let's input those two numbers. DNA was 478, 995. I'm going to go back on top. You're going to grab your EBITDA numbers. Will equal EBITDA 1474 plus that DNA number of 478, and you should now have a total of 1954 for your EBITDA. 1952 rather for your EBITDA. Now, I know we went through that pretty fast, but folks, at this point, you should just be checking those quick numbers here and there. Every one of these inputs should have been correct. Possibly the only one that would have been incorrect was the Costco Cash number because we wanted to include short-term investments. So, if you felt that was a little bit quick, well, certainly it was quick, but you should have all the numbers. Feel free to go back because now what we're going to do is let's actually take all these inputs from that page one on your sheet and let's crunch all of these numbers and start to analyze them. What we're going to do now is flip back to our inputs page and let's calculate some of these ratios. I'm going to zoom this out a little bit. Hopefully you can still see these numbers. I will read them out loud to you as well. Current ratio. And you can see now on your screen, probably not that visible, but you should have also included already by now the actual formulas. And let's look at our current ratio. Our current ratio, as you recall, is current assets divided by current liabilities. Now, I'm going to retype the numbers here, even though I could redo the formulas. But for your sake here, I'm going to show you the numbers, how you would have actually calculated on an actual calculator. For current ratio, recall our current assets was equal to 43,824. 43,824, and now I'm going to divide that by my current liabilities. Current liabilities from your inputs on top was 48,826, and you should have a current ratio of 0.9 times. Days inventory outstanding was equal to our inventory number of 32,191 from on top times the 365 days in the year divided by our COGS number 240,391. Folks, what this tells you is the following. It takes Walmart 48.9 days to sell their inventory. Remember the example we used in the previous explanations was 36.5, so they're more like 50 days. Days receivable. Let's take our receivable balance. What was our receivable balance from on top? 2662 multiplied by 365 divided by our revenue number of 315,654. That will get you a total days receivable outstanding of 3.1 days. So again, all of this is taking the numbers from on top, grabbing it down here into your ratios. What is my days payable outstanding? And we have the note here to use COGS. Our days payable, our accounts payable balance is 25,373 times 365. We will divide that by our COGS number of 240,391. And that, if you did the math, should get you 38.5 days. So folks, what that means is it takes Walmart 38.5 days to pay their suppliers and their vendors. Let's calculate our cash conversion cycle. Our cash conversion cycle will simply be our days inventory outstanding, which is that 48.9, plus the days it takes us to sell, to receive our cash, 3.1, minus the days it takes to pay our vendors and suppliers. We arrive at a cash conversion cycle of 13.5 days. You may be off slightly due to rounding, but that is okay. You get the point at this moment. Target. Let's do the same thing for target now. Target's current ratio, the current assets, is 14,405 divided by 9588, the current liabilities. That gets you a total current ratio of 1.5 times. Clearly, we can already see that Target is going to be a little bit more liquid than Walmart. Let's take a look at why as we finish the analysis. Target now, inventory, their days inventory outstanding, start again with your inventory number, equals 5838 times 365 divided by their total sales number of 34,927, which you should have gotten from on top. Let's quickly check that. 34,927, 243.91 was Walmart's COGS. Excellent. So now what we'll do is we'll look at Target's receivables. Their receivable balance, if we recall, was 5666 times 365 divided by the total revenue of 52,620. So our receivables days outstanding is 39.3. That's a really big number, especially versus Walmart's puny 3 days. Days payable for Target, we'll come back to that in a second, equals, what's their accounts payable balance? 6268 times 365 divided by our COGS number of 34,927 gets us 65.5 days to pay our vendors. That's looking pretty good. The cash conversion cycle simply is 61 plus 39.3 minus 65.5. Folks, think about that. Compare that with Walmart, 13.5 versus 34.8. That's a big difference. Let's come back to that in a second once we finish with Costco. Costco, current assets equal 8086 divided by the current liabilities of 6609. That will get you a total current ratio of 1.2. Days inventory outstanding, we will take our inventory number, again, 4015 times 365 divided by our COGS of 46,347 for a total of 31.6 days to sell their goods. That by far is the fastest among Walmart and Target. Days receivable, take your receivables balance of 400 times 365 divided by 52,935, which was our total revenue amount. 2.8 days, very similar to Walmart. We got to investigate why this 39.3 on Target seems to be so odd and so off. Now we'll look at Costco's days payable. Let's take our accounts payable balance. It is 4214 divided times 365 divided by our total COGS number of 46,347. 33 days to pay our vendors. Not too bad. Target seems to be doing really good with their cash. Cash conversion cycle simply will be our days inventory balance, 31.6 plus 2.8 minus 33.2. And we clearly see that it takes Costco 1.2 days to convert their goods into cash. Folks, think about that. Walmart is at 13.5 days. Target is at 35 days. And Costco is at a puny 1.2 days. In other words, it only takes Costco 1.2 days to convert all of their goods, what they do best, into cash. That is great. So by far here, we will say we will recommend Costco as our company of choice based purely on the liquidity ratios. Now, I did promise you, let's take a look at why Target is going to be at such a high receivable balance. Folks, what is the difference with Costco? Costco has a 39.3 days receivable outstanding versus everybody else at around 3 days. Well, why is that? What does Target have that Walmart and Costco do not have? They all accept credit cards, but Target has their own credit card subsidiary. They have their own store-branded credit card. And because they have their own store-branded credit card, they now have a larger accounts receivable balance that Walmart and Costco do not have. Because of the fact that Walmart and Costco do not have their own branded credit card, Target owns that credit card subsidiary, so the entire balance of their receivables on the credit card subsidiary gets consolidated up to the parent company of Target, and therefore, Target has a longer days receivable collection cycle. But you know what? That's sort of mitigated or offset by their longer days payable outstanding cycle. So maybe that's okay. But in any case, before you rush to judgment about a particular company's profitability or the numbers, you must investigate and dig deeper. So based on this, we will recommend Costco as the numbers that we will want to use. So let us now go ahead and calculate the rest of these numbers. Our profitability ratios, please make sure that you're going to use these as a percentage with one decimal place. Walmart's gross profit number was 75,263. You would divide that by 315,654, the total sales number. Once you divide the two, you get 23.8%. EBITDA for Walmart was 23,247. Divided by that same 315,654. And you will get an EBITDA margin of 7.4%. Their EBIT margin was, the EBIT equals their operating income of $18,530 divided by the same sales number, being a little repetitive here. You get a total of 5.9%. Finally, for profit margin, which is net income, equals 11,231 from on top, or rather from your first page, divided by the same sales number, 3.6%. Now let's do the same for Target and Costco. Target's gross profit was 17,693 divided by 52,620 was their total revenue number, for a margin of 33.6%, significantly higher than Walmart. And as you're running these numbers, the first thing you want to think about is, does this make sense? And of course it makes sense. Why does it make sense? Because Target is a little bit higher end than Walmart, so they have a little bit higher of a gross profit margin. But Walmart, on the other hand, is a very low-cost provider. Everyday low prices is their term. So from that perspective, they will take a hit to their margins to try to sell more goods. So it's just a slightly different business plan, and a slightly different approach, and a slightly different niche market. But as you start evaluating this, you clearly need to see that you have to understand the companies you're analyzing, as well as the specific industry and the specific sector that your firms are in. Target's EBITDA margin is simply going to be equals, what was your EBITDA? 5732 divided by sales of, again, 52,620, the total revenue, 10.9%, significantly higher by a wide margin, 3.5% higher than Walmart. Target's EBIT, operating income, was 4323 divided by 52,620. Finally, net income, 2406 divided by 52,620, 4.6%. Let's now take a look at Costco. Costco's profit margin equals 6588 over 52,935, their total revenue number. That gets us 12.4%. That is significantly lower than our other two competitors. EBITDA margin equals 1952 was their EBITDA divided by the same 52,935 of total revenue. That gets you an EBITDA margin of 3.7%. Well, folks, that is significantly lower. Costco EBIT, operating income, is 1474 over the same number, 52,935 of revenue, 2.8%. Profit margin equals 1063 divided by the same, 52,935. Folks, it is pretty clear to me here that Target is going to be the winner. So again, based on profitability margins and ratios here, Target is going to be the clear winner because every single one of these four categories, for every dollar of revenue and sales they generated, they've kept more of it versus Walmart and Costco. But I want you to take a look at these Costco numbers again. Again, you cannot ever just take these numbers at face value. You must understand and hone in on the numbers to see if they make sense. So let's look at why Costco's numbers are so much lower than everybody else's numbers. And does that make sense? So when we look at it here, we see their margins are significantly lower than our friendly neighborhood competitors, Walmart and Target. But does that make sense? Don't forget, Costco is a wholesaler. Because they're a wholesaler, by definition, that means lower margins, greater volume. So indeed, it does make sense that in fact Costco is at lower margins than our other two competitors, Walmart and Target, and that is because they are fundamentally a different business model. And again, that wraps back to the point. You got to make sure you dig into the numbers and truly understand why. Let us now go to the next section of our exhibit. Now let's look at our asset management turnover ratios. For Walmart, we will calculate asset turnover as our sales number, and our sales number, if you recall, was 315,654. So let's put that in, 315,654 divided by our sales number, our assets number of 138,187. That gets you a sales to assets turnover ratio of 2.3 times. What that means is, for every dollar of assets, they're able to generate 2.3 times that amount in sales. ROE was equal to our net income, 11,231, divided by our equity base of 53,171, getting us an ROE of 21.1%. ROA, very similar. Instead of using equity as your denominator, let's use total assets, 11,231, divided by 138,187 for our total assets number, which gets you an ROA of 8.1%. ROC equals, you will actually have to take net income of 11,231 plus our gross profit, 1420, divided by our asset base of equity plus debt. Our equity number was, our debt number rather, was 36,245 plus 53,171 for our equity number. So clearly you will see here that you should take our net income plus gross interest divided by equity plus debt. So of course here we can modify our formula to say net income plus gross interest would be the correct term there. That will be the formula you want to use. Let's do the same thing for Target. Target's sales was 52,620 divided by 34,995 for their assets. We want to take that, and you will see our asset turnover ratio is 1.5%, already lower than Walmart. ROE equals 2408 divided by 14205 equals 17% for Target's ROE, return on equity. Let's do the same thing for return on assets. Equals 2408 divided by 34,995, a return on assets of 6.9%. We will do the same thing for our ROC calculation. Equals 2408 plus 463. That's our net income plus gross interest. That whole thing divided by our equity and our debt numbers of 8872 plus 14205, straight from your inputs, and you get 12.4%. Clearly, you already see here, Target is not going to be the winner in these asset management turnover ratios. Finally, for Costco, we'll take 52,935 of our sales divided by our assets of 16,514. You get 3.2 asset turnover ratio. That's not a bad number. Slightly higher, actually pretty higher, much higher than Target, a little higher than Walmart. Net income, 1063 divided by 8881 for the equity base, 12%. Oh, that's a lot lower. That kind of makes sense because don't forget they have lower margins. ROA equals our net income of 1063 divided by 16,514 of our asset base, 6.4%. ROA, return on assets. And we will do the same thing here for ROC equals 1063 of net income plus our 34 of interest divided by our equity and debt base, which gets us 827 as well as 8881. And that will give us an ROC of 11.3%. It is pretty clear that based on these numbers, Walmart will be the winner here, although we can say that Costco is making a little bit more efficient use of their assets. When you start thinking about why does this make sense that Walmart's ROE, ROA, and ROC are a lot higher than their competitors? Well, very quite simply, it's probably because they have a lot of economies of scale. Let's go ahead now to our credit ratios. Our EBITDA coverage for Walmart will equal our EBITDA number, which is 23,247 divided by our 1420 of interest expense that we grabbed from the previous page. We'll do the same thing for our tie times interest earned. We'll take our EBIT number, which will simply equal 18,530 divided by 1420, 13 times. Debt to EBITDA equals our total debt of 36,245 divided by 23,247, 1.6 times debt to EBITDA. Net debt will simply be total debt minus cash. You're going to go equals my net debt of 36,245 minus my cash on the books of 64,14. That whole thing divided by my EBITDA, which was what again? 23,247. So you have a net debt to EBITDA ratio of 1.3 times. This net debt number will be important, especially as we get to Costco. Walmart's debt to assets equals 36,245 divided by our assets, our total assets of 138,187. That will be in percentage format of 26.2%. Our debt to equity ratio underneath will be equal 36,245 divided by 53,171. We'll take that in percentage format, 68.2%. Total debt to total capitalization, a little bit trickier, equals 36,245 divided by our equity and debt base of 36,245 of total debt plus 53,171. And that will get us our 40.5% of our debt to equity over debt to total cap percentage. Let us now go back on top to our target. Target will say equals, what's our EBITDA? 5732 divided by 463. That gets us a 12.4 EBITDA coverage ratio. We'll do the same thing for our EBIT. EBIT equals 4323 divided by that 463, 9.3 times. Debt to EBITDA, 9872 divided by my EBITDA number of 5732 gets me 1.7 times. Net debt to EBITDA equals my total debt number, which was what? 9872. Minus 1648 of my cash. I will take that whole thing divided by 5732 of EBITDA, 1.4 times. My debt to assets will equal 9872 divided by 34,995. That will get me 28.2%, slightly higher than Walmart. Then for my debt to equity ratio, the same debt of 98.72 divided by 14,205 of equity, 69.5%. For my total debt to cap ratio, I would say equals that same 98.72 of total debt divided by that 98.72 plus my equity base, 14,205. And I will have 41% debt to cap. And when you look at these numbers really are not too far apart. They are very similar and very close. Let's take a look at what Costco says. Costco's EBITDA coverage equals 1952 divided by $34, 57.4 times. If you were to use actual full precision on our numbers, you would get a slightly different number, but that's okay due to rounding. Interest times interest earned equals my EBIT of 1474 divided by the same $34. 1474 divided by 34, almost got you there. 43.4 times. Debt to EBITDA simply equals 827 of debt divided by 1952 for my EBITDA, 0.4 times. But now we run into a little tricky problem here. What's my total debt number again? My total debt number was 827 minus my cash. My cash was 3460 from on top because you were going to include your short-term investments in your cash and equivalents. That number now gets you actually a negative number. That's okay. Yes, it is possible to have negative net debt. You would take that and divide by EBITDA of 1952, and you have a negative 1.3 net debt to EBITDA percentage or amount. Debt to assets equals, what's my total debt? 827 divided by 16, 514 for debt to assets, 5%. Debt to equity equals my debt number of 827 once again divided by my equity base of 81, 9.3%, very much lower than our other two guys. Debt to total cap equals my 827 divided by that 827 again plus my equity base of 8881, and that will get you 8.5%. Now, folks, think about this. There's no recommendation that I'm going to make here because I'm not going to necessarily say is one good or one bad. What I will make is an analysis and an observation to wrap this up. Going back to our numbers, I will take a look at this and I will say the following. I will say that Walmart and Target are very closely aligned. I will probably make the observation Target has a little bit more debt because they have a slightly higher debt to assets, equity, and total capitalization. Their net debt and their debt to EBITDA are also slightly higher, but more importantly, their EBITDA coverage and their EBIT is a lot lower. They have a lot less flexibility than Walmart here. And you know what? The analysis might simply say Walmart might be in the middle. And one can say Target has maybe too much and put a question mark. Maybe not. Why? Because they have their credit card subsidiary that they need to fund. Costco, on the other hand, I won't say if this is good or bad, but I will make the observation that they have way too little debt. Way too little debt. And if you look at this, Costco's EBITDA coverage is through the roof. They can make easily any payments. They basically have no debt on a net basis. And whatever little debt they do have is such a small percentage of their total capital structure. Now, if you look at this analysis, again, we're not going to say whether or not Walmart, Target, or Costco is better or not. It's just the way it is. But you could make the analysis that potentially Costco has too little debt, is under-levered. In that case there, I will point you to our exhibit and our module on share repurchases. Go through that quick video and you will have a full explanation as to whether or not exactly undertaking a share repurchase and under what circumstances would that actually create additional value to the equity stakeholders. And we give you two or three different conflicting views and you can make your own decision. But again, the case here, the analysis, the synthesis of all of this together wrapped up is the fact that you must understand the accounting terms, the income statement, the balance sheet, the cash flow. You have to understand how everything's integrated together. You have to understand how to analyze those numbers in a form of ratios to start comparing and contrasting different companies. Number crunching purely by itself is not enough. You need the qualitative aspect as well as the quantitative aspect, which hopefully I provide you a slight glimmer and glimpse into that in our little exercise here. If you want to, you can also grab the income statement, balance sheet, and cash flow of any other company and do a similar analysis as well to really reiterate and hone in these concepts to make sure you understand how to